In midday and midweek trade, the major U.S. equity averages continue to extend losses. While the averages may be off session lows, we are still in the red. We got some weaker than expected data as well as some Fed comments. So joining me to weigh in on the action is Keith Bliss of Cuttone Co. Keith, thanks for joining me.
My pleasure, Remy. Good to be with you.
Well, we're here smack dab in the middle of the week, and we have been keeping an eye on equities as well as oil prices. Now, we got some mixed comments out from the Fed. So what do you make of today's market action?
Well, today's market action, like the market action since January 1st, has really been driven by oil prices. In January, there was a 98% correlation between the movement in equity prices and oil prices, and that seems to continue. I think that misses the broader point of what's going on underneath the market. You mentioned the comments from the Fed speakers, and we're going to hear a lot of Fed speak in the run-up to the March meeting. They're trying to all get their speeches in before they go into their quiet period. And Stanley Fischer, of course, was trying to throw a little bit of cold water on the notion of negative rates here in the U.S. And me, for one, I'm glad that he did. But as long as we have this volatility going on in the oil markets and the Fed speakers, expect greater volatility inside of the equity markets as well. And that's the action we're seeing today.
And Keith, you just brought up the rate outlook. We still have to wait a couple weeks until we get to that Fed meeting. But given that we've been seeing some negative interest rates from central banks around the globe, what do you make of that?
Negative interest rates, in my opinion, having been schooled as an economist and a financier, that is an act of desperation, because it really, and it's really symbolic when you look at what happened in the ECB and what's going on inside of Japan. In that when the ECB did it, they were doing it to try and get the banks to disgorge the excess reserves that they'd put on deposit, but there was really only a few billion euros, so it wasn't going to be that meaningful inside of the European economy. So again, negative rates is, gosh, it just goes against all financial logic that you can imagine. You're supposed to get paid for putting your capital at risk, or putting your capital or lending your capital to somebody, and that notion has now been abolished. I sure hope that we don't see that wave come across the global economy, but if it happens here in the U.S., it will. But it is a real issue, and I was glad to hear Mr. Fischer actually put a little cold water on that notion.
And Keith, as the market closes and heading into tomorrow's session, we'll be keeping an eye on Bullard's comments coming out later tonight. But we can't forget that we're paying attention to global markets, Britain in particular, given concerns about a Brexit ahead of the referendum this June. But we're also continuing to watch what's happening in China. So what's your global outlook?
Well, I think the global outlook is tracking along. One of the things that are more concerning to me, other than what's happening on a day-to-day basis in China on their markets, and by the way, I had the good fortune of meeting with some Chinese business people yesterday for lunch, and they are all talking about the volatility that they foresee inside of the Chinese markets will continue for a long time, or what's happening with the so-called Brexit. That vote is not coming until June 23rd. Expect some volatility in exchange rates and some other economic indicators up to that. But I'm really focused on global growth and productivity, what we see around the globe and also here in the U.S.
Keith, I told you that was the last question, but since you mentioned global growth, we get GDP at the end of this week. How optimistic are you?
Not very. I, for one, don't really believe the politicians and the pundits that are trying to tell us that all is well here inside of the U.S. economy. There's a lot of data points below the headlines that suggest that we've still got a long way to go. The other reason that I'm not real convinced about our own economic situation here in the U.S. is if you look at the index, the Russell 2000, that is the most emblematic of U.S. economic growth, is the Russell 2000 because of its constituent group, and that has been a lagging index for a long, long time. So the market is telling you they don't believe the economic story here in the U.S. We're going to keep bumping along at really low growth, stagnant growth, which is not going to propel the markets or wages and income dramatically. So I, for one, am not that encouraged, at least today, on what we see for the economic story anywhere around the globe for 2016.
And Keith, it is an election year, so I'm sure all the politicians will be keeping an eye on that as well. Thanks for joining me.